interest rates are now going into negative territory more and more often, so it's the new normal. And of course, there's a pun with Gaussian models for interest rates, which then accept both positive and negative. But as my colleague, Tryon Purvo at McMaster said, it's a bad joke because you should just say on the normality of interest rates, because then it's both positive and negative. But look, it's just a joke, so I don't have to explain myself that much. It's joint work with Alex Lipton, who many of you might know, was most recently at Bank of America. Now he retired and embarked into many other different adventures, including visiting appointments all over the world, and more recently trying to start a new bank, a completely digital bank, so he's raising money for that. So some exciting things on the pipeline from Alex. So what are we talking about? We're talking about policy rates. That's going to be the primary focus of the talk and of the paper. So policy rates are rates that are controlled and announced and discussed by central banks of different countries. And these are graphs of how the policy rates for some relevant countries have behaved in the past few years. So on the left panel here, you have countries that didn't quite go negative. So for example, the UK, the rate in the UK remained at 0.5%. So that's percentage points in the axis there. So half a percentage point. In the United States was always a little lower. In Japan, it has hovered around 0 for a long time and gone slightly negative most recently. And then the only remarkable one in this panel is the Eurozone, which after a spectacularly stupid increase in interest rates right in the middle of a recessionary period, decided then to do what was required, which was to lower the interest rate, and then decided to go even lower than 0. Was the largest economic bloc that adopted negative interest rates as a policy rate. On the right panel there, you have many countries that are primarily in Europe and related to the Eurozone, so they're the largest trading partner and so on, and they mostly follow the movements that the European Central Bank does. So there you have Sweden, Denmark, Bulgaria, Switzerland, and Hungary. And you see that after some point in 2013, early 2014, all adopted negative interest rates as their policy rate. Why was it deemed necessary? Well, if you remember, about 10 years ago, there was a major financial crisis, which then provoked a contraction of, so this is GDP in the axis here, this is GDP growth. So a recession is when GDP growth is negative, and then a recovery is after it moves to positive territory. And it has moved into positive territory, but kind of slow GDP growth. This graph starts in 2004, 2005, where it was already slow. If you make this graph longer, go back, for example, to the 50s, you would see much more robust GDP growth year to year. So don't get too sort of happy with this territory here. It's still not very satisfactory. But you can see why many countries in the Eurozone then adopted negative interest rates as of more recent times, because the contraction that happened in the United States during the financial crisis sort of happened a little later in the Eurozone. When the crisis kind of migrated, that's when the start of the troubles with Spain, Ireland, Greece, and so on started, and Italy in the Eurozone. And so you see this kind of contraction of GDP there happening later, and then coming up again, but still not too robustly. So what were the reasons that the countries that adopted negative interest rates gave in there? Because whenever you do that, the central bank needs to do a press release and carefully explain why they're doing something. And those are the words that were taken from the press releases of each of those banks when they announced negative rates. And most of the reasons have to do with price stability. We're going to review the mechanism in a second of what they mean. But typically, when you think of price stability, especially if you're Brazilian, you think that you want to prevent a very high inflation. I grew up with a 20% inflation a month. Try to imagine what that is, okay? Well, 20 to 30%. So that would mean, on the thousands of percent per year. It's completely unimaginable for people outside Brazil. And that was not deemed to be out of control. That was like business as usual. So everybody in this room who was doing banking back then, they had to deal with that as if it was normal, so to speak. So we're not talking Zimbabwe. We're talking about a functioning country that had to survive with that kind of inflation. But anyways, well, functioning is debatable. So when you think of price stability, you think of trying to prevent inflation. No, what these countries are trying to prevent is deflation. And we'll look at the mechanism in a second. But then some other countries also, again, the example of Brazil is appropriate. When we think about trying to protect the currency, is to protect the currency against devaluation. Is meant to be, a kind of a predatory attack in the currency that is betting on the fact that the currency is going to devaluate. It's hard to maintain, the peg between the Brazilian real and the dollar if they ever wanted to maintain that. What these countries are trying to do is the reverse, is trying to prevent currency evaluate. So trying to prevent currencies from going up against other currencies, which then is going to be detrimental to their economies because their exports are going to be more expensive and so on and so forth. So this is just to tell you that really negative interest rates are related to this sort of Alice through the looking glass world where everything that you think it's normal is really the other way around, is really upside down. How was it greeted? So that's negative interest rate policy is the acronym that it's known for. So it was greeted with uniform dismay. And it's hard to imagine a policy that both left-wing and right-wing economists despise more or less equally. So my friends from the left, and I still have many of those, would take a position represented here by Robert Skidelsky, the biographer of Keynes, where it's essentially that adopting negative interest rate is a cop-out, is a way for governments not to do what they're supposed to do, which is fiscal policy. So a Keynesian recipe for a recession is that the government should go and fill the so-called demand gap. It should be spending when the rest of the economy is not spending, and then promote recovery. And because they cannot do that for one reason or another, they go and sort of try to do it through monetary policy. That's the criticism from the left. The criticism from the right, so my libertarian friends, and I also have some of them, some are even in the audience today, let me see. They despise it for completely different reasons. It's because, any sort of action from the government is intrinsically distortionary. In particular, controlling rates. Controlling rates is just like controlling any other price. So this is an intervention in the market. It has all sorts of negative and unintended consequences. And you see, it's what this guy here calls radical monetary policy, and even greater misalignment between output and demand. So it's hard to piss off people from both sides of the political spectrum, but negative interest rates sort of manage that accomplishment. So if you go back to positive territory, okay, imagine the times when rates would be positive most of the time. How is it supposed to work? Why is it that if you are in a recession, you would like to lower rates? What's the rationale for that? Well, there are many channels. One of them is this for, if you reduce the policy rate, then the bank rates, both the rates that the banks charge on their lending and that they offer in their deposits go down accordingly. Why is that? Well, here is explained in terms that, it's easier to raise funds because you can borrow from the government at a cheaper rate, and then you pass that advantage to your consumers. More realistically, what's happening is that the banks will have part of their assets in the form of reserves with the central bank. Those reserves are going to be paying either the policy rate or the policy rate plus or minus some fixed amount, so something that is close to the policy rate. And what happens is that if the policy rate goes down, then this is an asset that is now generating a lower return, so they would like to replace that asset by a higher yielding asset, for example, a loan on a mortgage or something. So they will try to offer some more mortgages, but presumably everybody who could take mortgages at the prevailing rate already took them, otherwise they would go and have more mortgages. So to entice new customers, they would have to lower the interest rate that they are offering, but that's still good for them because the rate that they're making on the reserves is even lower. So they're going to substitute the reserves, so they offer a mortgage, somebody takes a mortgage, takes the money out and puts in another bank to pay for the house deal that they just made. That just means that they remove reserves. So effectively, they swap the reserves by mortgages that are earning a higher interest. Now, because banks make their profits on the differential between the lending and the deposits that they have, they would also like to then reduce the rate that is being paid on the deposits, and the consumers will accept the rate, the lower rate, because they have no other alternative on what to do with their deposits, because if they want to take the money out and put on alternative, like liquid money market mutual funds, the money market mutual funds are going to be invested in assets that are also earning lower rates, because all the loans that are around in the economy, the securitized loans, are in lower rates anyways. So there is a corresponding reduction in both the lending and the deposit rates for the banks. This means that it's easier to obtain funds to consume and to invest, and those are the primary engines of growth in the economy. So if you want to consume and don't have money, you can borrow at a lower rate and go ahead and buy a new house or a new television or a new car or a new cell phone. If you're a firm and you don't have enough money to expand your investment capacity, you go and borrow, and then you start selling again, and by selling you pay your workers, and then the workers have more money to consume, and then the economy is supposed to heat up. So there's an increase in aggregate demand. And finally, there is an effect on currency. Those countries that were interested in protecting their currency, remember they're protecting their currencies from going up. So how do you prevent a currency from going up? Is by reducing the attractiveness of that currency. So if a given country pays lower interest rate than another country, then there's an incentive for investors to go and take the money out of that country, put in the country that pays more interest rate, so that raises the price of the other currency and lowers the price of your own currency. So that's the intended objective of the policy. Okay, so let's see if that has anything to do with reality. Well, if you blow that picture that I had before for GDP, but now I'm just looking at lending rates, deposit rates, and the policy rate on the top panel here, what you see, you can't quite read, but the lowest rate is the policy rate. The one that is almost on top of it is the deposit rate. So it means that the rate that banks are paying on the deposits for customers is almost the same as the policy rate, and it moves in tandem with the policy rate. And moreover, the lending rate also moves accordingly, but with a spread. So that's the spread that justifies the profitability of the banks, and it's kind of well correlated and well behaved. So there is some empirical evidence that the channel that I mentioned before of lowering lending and deposit rates actually works in practice. For currency evaluation, it's not that clear. Here I'm plotting the federal funds rate in the United States versus the US-UK differential in their currency. And well, okay, I mean, it's kind of correlated, and it's in the direction that you would expect. So namely, when interest rates in the US go up, the dollar appreciates against the pound, and when the interest rate in the US goes down, then the dollar depreciates against the pound. So this graph is not as clearly correlated as that, but nevertheless, it goes in the right direction that you would expect the policy to work. What goes differently if you are in negative territory? So all that I explained was, suppose rates were at 5% and you do a little reduction in the rates, that's what you would expect to see, the effects that I just described. But what if you are close to the zero lower bound? Well, then economists talk about the existence of this physical lower bound. So it's not quite zero. You can go slightly below zero. But at some point, it becomes really dumb for somebody to keep their money in the bank if the bank is charging them an interest rate. So in other words, if the deposit account is offering you a negative interest rate. So if it's slightly lower than zero, say, a quarter of a percentage point or 10 basis points or something, then you start to think of that as more or less a convenience fee. Sure, you're paying to have the money there in the bank, but it's kind of inconvenient to move around with lots of cash in your pocket, and transactions you always have to do with cash, and you need to store that in a safe and so on. So that's kind of inconvenient. However, if it starts to be really negative, then at some point you're going to say, no, enough is enough. I'm going to take the money out of the bank. And then you pay that convenience fee to someone who builds a safe in your house, and then you buy a safe, or there will be some services that provide this kind of safe guard and transportation of your money for less than the interest rate that you're being charged in your bank account. So zero is not really a hard lower bound, but you really can't go too much below zero. That would be the so-called physical lower bound. So that's what I say there. It prevents deposits from following the policy rate if the policy rate is too negative. Banks don't want to be the first bank that starts to charge interest rates on their customers, because then they'll take the money and put it on the other bank. So they're going to, lose in the competition, they're going to lose market share. So because no bank wants to do that, no bank is going to do that. And if they don't do that, then they squeeze their profitability. So if they squeeze the profitability, they're going to be a bit reluctant in really going for the low interest rate on the loans that they provide. So that means that the policy is not going to be that effective. So this is what the economists call kind of an economic lower bound, which might happen even before the physical lower bound, exactly because the physical lower bound exists and you don't pass that to the deposits by making the banks less profitable, because the whole point depends on banks being an engine of credit flowing in the economy. If the banks are not going to be doing that, for example, if they start to look for profits elsewhere, like by charging higher fees to the consumers, or by doing whatever type of operations that rescue their profitability, then this is not going to be too effective. Okay. So there's this paper by Brunemeyer and Colby that tried to calculate what this economic lower bound really is. Well, how did it work? So we talk about how it was supposed to work in positive territory, why it wouldn't work that well in negative territory. Now let's just see how it actually worked. So just like the argument for the physical lower bound predicts, deposit rates didn't go negative. However, lending rates did go down, just according to what you would expect, that they tried to make replace the reserves that are paying negative rates by loans that will pay a little bit more than that negative rate. The profitability didn't get too much impaired, exactly because they were clever to compensate. Banks were clever to compensate that in other ways. For example, if it's less expensive to service a loan, then there's less likelihood of a firm defaulting, so they don't have to spend too much in monitoring the loans, and they can also make up in scale. They can give loans to many more firms and make up the lost profitability by scaling up their business. Mixed results on exchange rates, because I told you in the beginning that the channel for exchange rate was not that strong anyways. And there was no evidence of people taking money out of the banks and hoarding the cash, primarily because deposit rates didn't go really negative, so nobody had to do that, even if you live in Switzerland. And most importantly is the last point. The whole point of the negative rate was to try to stimulate the economy, was to try to bring inflation up again by that channel that I mentioned of increased demand, because if you have increased demand, then that's going to put upward pressure on prices, and everything will start working as in a normal economy. And growth. So both inflation and growth were supposed to go up, but they didn't in most countries that adopted negative interest rates. Now, what you should ask, so this is just graphical evidence what I just said. There's deposit rates going down, but never going too much below zero, except for a few, so this for large deposits. For a few large consumers of banks, they did charge negative rates because those are precisely the consumers that would not be incentivized to take, a truckload of cash out of the bank. So they would be prepared to pay this convenience fee, so to speak. But this would be only for bank accounts of more than $100,000 or 250,000 Swiss francs or something like that. Lending rates did go down, as I just explained. The volume of lending went up. That was the compensating mechanism for banks to maintain profitability. Now, and this was for exchange rates. So this is where you see, so this was the date when negative rates were announced in each of those countries. Exchange rate normalized to 100. Some countries, their currency appreciated, some countries it depreciated. You can't really tell what was the strong effect on exchange rates. But I was not holding my breath about exchange rate anyways. And this was the bit about core inflation definitely not picking up, definitely not having a tremendous spike once interest rates went negative. But you should really go back to the first graph that I presented and ask yourself, what you should expect. These rates never went too negative. I mean, for the country that went most aggressively, which was Switzerland, that's close to 1% negative. So minus 100 basis points, minus 80 basis points or so. Now, yes? 75, okay, so yeah. So I better know that because a week from now I'll be in France and I'll be in a panel discussing with the Swiss central bank who was responsible for implementing that. And I guess the difference between 75 and 80 is crucially important at that point. What you should compare here is with what interest rates did, for example, in the years leading up to the crisis. They went down from like 5% to 0 in the United States. You read the accounts of the Federal Reserve and what Ben Bernanke had to do and so on. So on the first FOMC meetings that he chaired, it was about 5%, and then gradually went down and down and down in a short period of time. So now that's something that you can expect to have an effect. A 5%, that's 500 basis point reduction. Now, if it just goes down by 75 basis points, the response should be meh. It doesn't change a lot of behavior from consumers. It doesn't change a lot of behavior for banks. It doesn't change a lot of behavior for firms. So my reaction to it is that, sure, the results were tepid because the policy was not strong enough. So the question that Alex and I put to ourselves was, can we come up with a model where if you have negative rates going unrestrictedly negative, so in other words, there is no physical lower bound, so suspend your disbelief for a second just to look at the model, then we'll go back to that at the end of the talk. So if there was no physical lower bound and central banks were really brave and aggressive and pursued monetary policy that would lower the interest rate as much as necessary. So pretend you're Mario Draghi saying, we'll do whatever it takes to save the euro. So here I want the central bank to say, we'll do whatever it takes to stimulate the economy. And if the only thing we can do is to control the interest rate, then be it. Let's have the interest rate as negative as possible. Can we write down a model in which this would have a stabilizing effect? For both positive and negative rates. So, of course, I did my own class of my favorite models, which are stock flow consistent models. So here, if you've been paying attention, or even if you weren't, by listening to me so many times, at some point you might have picked up on the fact that I've been working on this model for a while. So that's the Keene model. It's a model that looks at different sectors of the economy. So the original model doesn't have a government. So you have households, firms, and banks, and they are the transactions that those sectors do. So that's trying to capture all the dynamics that I was telling you before, of firms paying their workers, the workers buying goods, then it increases the profitability of firms, they can pay their loans, and so on and so forth. So that picks up all the close relationships in this economy, except that now I put an explicit government sector in there. And what the government does is to spend, so there's some government spending here. It taxes. In the simplified version of the model, I'm just putting taxes directly on corporations and not on households, but you could have taxes on households as well. It's just because the model, as it's written, it concentrates on investment, but we have versions of the model that concentrates on consumption, so we could do that for households. But let's concentrate on what firms are doing here. So the government spends, the government collects taxes, the government pays interest on the debt, and the difference, so if at the end of the day there's a deficit, this is what is being discussed now at the US Congress. What's going to happen if the Republicans pass their tax cuts? Well, that means that this term is going to get smaller, so that means that the deficit is going to increase. So the negative balance here at the end of the day is going to increase. If that increases, then the government has no choice but to issue more debt. So if there's deficit from one year to another, then that increases the debt of the government, which is what they're saying, that the effect of the Republican tax cuts will be a cumulative increase on the debt of about $1.5 trillion over 10 years, which is kind of, is the flip side. So I'm going to adopt a policy here which will maintain the government debt in this model in a stable trajectory. So I'm not going to do what the Republicans have tried to do, which is to lower taxes and then blow up the debt. And I'm also not going to do what Keynesians would like to do, and what Stephen Bannon wanted to do if he didn't get sacked because of silly immigration policies, which was to, instead of having a $1.5 trillion decrease in tax, have a $1 trillion increase in government spending. That's what he said he was going to do, which, by the way, is what Bernie Sanders would do too, and would do wonders to the United States. But I'm not going to touch on either of those possibilities. We're going to have a stable trajectory for the debt, and the only thing that the government here is going to be controlling is the interest rate that is paid on the government debt. And now you might say, oh, but how can the government control the rate that they pay? Because they really can, because when the government issues debt that is in principle bought by the private sector, but if the Federal Reserve wanted, which they actually do a lot, that's how they do monetary policy, the Federal Reserve can go and buy all the government debt by just issuing liabilities of the Federal Reserve, so they can monetize the debt as much as they want. So the short rate, and this is, we're going to assume that the government is only issuing short-term bills, it's entirely the rate that is paid on that is a policy rate. So don't let anybody fool you that this is a market rate. It's not a market rate. It's a policy rate, because then everybody who is going to be trading in that government instrument is trading against the Federal Reserve, and if they go higher or lower than that, there's an arbitrage. So by no arbitrage, the two rates are going to be exactly the same. So anyways, this is the instrument that the government is going to be controlling in this model, which is the short rate on the government debt. Now, how does it do it? Well, as I said, this is the two variables, government spending and government taxes. This is the evolution of the government debt. This is the variable that we're going to aim at a constant ratio asymptotically. So they're not going to be fooling around with these two things, but they are going to be controlling RG. How do they control RG? As a lagged target. So there's going to be a target rate, which I'm going to call rho, and the government, through monetary operations, is going to try to achieve that target. Okay? So this is the rate on the government debt, and this is the target. If the target is above, then the government will do monetary operations to raise the rate. If the target is below, it's going to lower the rate. But what governs the target? Well, traditionally, for example, if you follow literature on the Federal Reserve, they follow something called the Taylor rule. So the Taylor rule was proposed by John Taylor from Stanford, who until recently was a contender for the chairmanship of the Fed. And it's the idea that you try to look at what inflation is doing and unemployment. But if you were Taylor, you would concentrate only on inflation. The Fed has a dual mandate. They need to look at inflation and employment. And it's kind of a linear regression thing that he fixed what the coefficients of the regression is, and he's monitoring one variable. So if the inflation is high, then you raise the target. If the inflation is low, then you lower the target. Here I'm going to do something slightly more sophisticated. What I'm going to look is that the target rho depends on the difference between the actual growth rate, so K is the total capital in the economy, and by the growth of capital, this mimics what the actual growth rate of the economy is, compared with the potential growth rate. So the potential growth of the economy comes from where the economy can grow. It can grow from two sources, population or productivity. That's the only way that an economy grows. So if the actual growth rate is below what the potential is, then that means that this target should be reduced. By the same logic that we were saying before there, you need to stimulate the economy. So if the potential growth rate is low for a while, then the target is going to come down, and then the policy rate is going to follow the target and it's going to come down as well. And this, we hope, we need to show in the model, will have the effect of stimulating the economy so that the growth rate goes up, and then the target can go up and interest rates can go up again and eventually reach some sort of equilibrium. So there's the remaining assumptions. You can just, for example, assume that the profit of corporations is related to the investment of corporations is related to their profits. That's not a far-fetched assumption. You can do some regression of profits and investments, and you find that as well. And you have to assume some dynamics for the price level and inflation, so that's where the Phillips curve comes in. This is where there's more similarity with the Taylor rule, but I'm embedding that in the model as not the main driver. That's just an auxiliary variable of the model. The main driver of the model is actual growth. So that's what Bernie Sanders would tell you. You need more investment to make the economy grow. So focus on the variables that are actually important. So this is the productivity rate, and that's the population rate that I mentioned before. Other assumptions is that I'm going to assume flat out that the deposit rate is equal to the policy rate. That graph for 50 years showed that it pretty much is equal, and that the lending rate, which is the rate that business pay on their loans, which then enters in the previous slide in their profitability. So you see the lower the rate that they pay on their loans, the higher is their profit, because then there's more money left over. And if the profit is high, by this function kappa, they're going to be investing more. And if they're going to be investing more, they're going to be increasing the capacity of the economy, and the employees are going to be getting more wages, and they're going to be consuming more, and then that's the engine of recovery. Okay, so you see the logic of the model, if not the mathematics of the model. So I'm going to assume that this lending rate is the policy rate plus a fixed spread, which again is not totally unjustified from the historical data of the interest rates. And then we reduce the model to this 5-dimensional dynamical system. You can do some analysis on it, which is included in the paper, but there's nothing better at this moment, it's late in the day, than show some simulation. So that's the equilibrium that you would achieve if you go to an interior equilibrium of the system. So let's just see, but that's not the only equilibrium. You could remember from some of my previous talks, in any of these dynamical systems, there's the possibility that the system doesn't go to its positive growth rate equilibrium, it goes to an equilibrium where some variables go to infinity. Namely, the key variable that can go to infinity here, that can blow up, is the level of debt. And if the level of debt goes to infinity, then payment on debt goes to infinity. That reduces profit. If it reduces profit, it reduces investment, and it's going to make the economy contract even more. So that will drive the economy to a deep recession, and that's not a state where you want to be. So I'm going to take some functional specification of some of the, this is the investment function, that's the Phillips curve. The parameters were parameters that we estimated in a separate paper from different OECD countries. So you can check what the parameters mean. Later we can discuss it. But here are the simulations. So this is a simulation where everything goes well. Everything goes well because you have a moderate initial level of debt. So the level of debt to GDP is this variable L for loans, and it's meant to be a proportion of GDP. So you have here a starting, I think it was at 0.6. So that's 60% of GDP in private debt for the beginning of this simulation. So this is more or less the level of debt of a healthy European country. Brazil is at that level of private debt. The United States is much higher than that at the moment. It's about close to 2, so it's 1.9. Japan is 1.8. Some countries are above 2. I think the record at this moment around the world is Cyprus, which is 2.3, so 230% of GDP in private debt. Okay? So if I put that initial condition, which is a benign initial condition, and run the system, what you see is that the wage share converges, the employment rate converges, the level of debt converges, and crucially, inflation converges to a positive value, and the economy grows. And this has no monetary policy. So you see, without monetary policy. So this is the economy without intervention from the government. So this is a libertarian dream. There's not even a government mentioned that. Yuri is just looking at his cell phone, already mad at me. But the next model is, the next simulation is when I start with a higher level of debt. So admittedly, that's 10 times higher, but it's not too far-fetched. It reached levels which are comparable to that during the, the lead up to the Great Depression in the 1930s. That's a key variable that you should observe for different economies. It never got that bad, but I'm just making it really bad and seeing if monetary policy can rescue from that. So this is without monetary policy, with a high level of debt. What happens is that you never recover. That just continues to increase. The wage share collapses, the employment rate collapses, the economy collapses, and inflation collapses to negative territory. So this is deflation. So this is where soup lines start to form and things like that. Okay? So that's extremely bad. What we want to know is what happens if you put monetary policy in that. So put monetary policy, so now it's with monetary policy and benign conditions. Then basically nothing happens. What the monetary policy does, if you remember the simulations 2 slides ago, which I will flip now, so that's without monetary policy and good conditions, with monetary policy and good conditions. The only perceivable difference is a reduction in oscillation, because that acts as a kind of a counter measure. So when the economy is bad, you put negative, low interest rates, which don't need to go quite negative, you see? So that's just the target, that's the target oscillation here. It oscillates above 0, and that's the actual rate that is implemented. And what you see is it just dampens the oscillations, but everything goes to a finite level. The level might be slightly different than what it was without the monetary policy, but not significantly qualitatively different. The key difference is here. If you have with monetary policy and high initial debt, so put an initial debt of 6, now I'm going to flip 2 slides back. Without monetary policy, it crashes. You do nothing, this economy crashes. With monetary policy and no other government intervention. So, and that's not because I don't believe in government, in fiscal intervention. In fact, I presented here 3 or 4 years ago a paper that did exactly fiscal intervention. But that's the constraint of the model. Suppose that the government cannot do fiscal intervention because they have some crazies in Congress. So they have an independent central bank that could do negative interest rates, this is what would be achieved. But you notice that for this to happen, the target rate oscillates a lot in negative territory, and the actual realized effective rate on government debt goes negative, and this is now not in percentages, that's a real number, so that's 2%. So, so that's 2%, and it never gets to 2% in that simulation, but it gets to minus 1%. Now notice that minus 1% is already lower than Switzerland. So it's already sort of lower than the physical lower bound. But nevertheless, it's effective in stabilizing the economy. Now let's make it even worse. Let's increase the level of the initial debt to, for example, 8. So that's 800% of GDP. And what you notice is that, so the result is robust in the sense that it will still stabilize the economy, but now you need even lower interest rate for an extended period. So you need to swallow about negative 2% interest rate for many, many years for this economy to effectively recover. But now you have a puzzle. So I said, suspend your disbelief that there is no physical lower bound. Let's just see if you can have an aggressive monetary policy that stabilizes a severely impaired economy with a very high level of private debt, and the answer is yes. But now you are allowed to collapse your disbelief. So don't suspend it. Now go back and say, okay, but you said that there's a physical lower bound. So what prevents, what makes you be, what breaks that, right? So how can you have this negative interest rate? And so that's, breaching the physical lower bound. So how do you do it? How would you, in practice, not have this effective lower bound on the interest rates? Well, as we've seen, it might require rates that are very negative. But this is incompatible with the existence of cash. So somehow cash needs to go. So proposals for going below the physical lower bound include the following. So now I'm going to give you a laundry list of crazy ideas, and you just need to pick the one that you like. But all of them include, in one way or another, getting rid of some property that you associate with cash. So the first one is that you could tax cash. And this was actually done through the Middle Ages, and it's more recently proposed by Geisel in Germany, and Fisher in the United States said that, yeah, that would be a very good idea. If cash was really something that needs to be re-stamped. So you take a note out of the bank, and it says 100 reais, and every month you need to go back to the bank and sort of make that note valid. And when you get back to the bank says, but this note is not 100 reais anymore, that's 95. And you say, well, why would I do that? Because if you don't do the timestamp on that banknote, it goes to 0. So if you don't bring it back, you might as well abandon it. So you do bring it back, but once you do bring it back, they stamp it again and say, you thought it was 100, but it's not, it's 95. And then you do that the next month, and it's 90. And then it keeps losing value. So that gives you an incentive to get rid of the cash, so to speak. So you would prefer to keep the money in your deposit account, even if the deposit account is paying negative interest rate, because that's less than the tax that is being imposed on your banknotes. The other proposal goes in the same direction. It's just that, let me eliminate that there. So what is implicit in the assumption that you're going to take your money out of the bank is that there is actual cash in the cash machine, in the ATM, for you to take out. It means that, it's an implicit guarantee from the government to maintain the parity between deposits and cash. Every central bank around the world makes that implicit guarantee, that if you as a citizen want to convert a deposit into cash, you have the right to do that, and if there is not enough money in the bank machine, the government is going to send a truck with money and put it there, and you can take it out of there. What these people say is like, no, just treat money as any other commodity, the supply of which is controlled by the government, and the government says, we're going to print not what you want to withdraw, we're going to print what we want to be around. And now, if you want to take that money out of the machine and there's not enough money in the machine, what you go is you go to somebody else who has cash and you try to exchange your deposits by that cash. And because that cash is now more valuable, you're going to pay more in your deposits for that cash, and then that effectively creates an exchange rate between cash and deposits. So that breaks the parity, and what it means is that in periods of negative interest rates, it's going to be less attractive to, well, you're gonna get rid of your deposits, but once you put it back to pay other things, you're gonna get less, so you're not gonna try to do that round trip, so you accept the negative interest rate on your deposit. Well, both of this I deem to be a bit disruptive because it kind of completely changes your relationship with what you think is cash, which is something that you go to your ATM and you take exactly what you want, and that reduces your bank deposits by exactly what you took out. So our more modest proposal is abolishing cash, not taxing it or making it at par with deposits. Just get rid of cash altogether and make everything electronic. So now this means that there is an electronic currency, not as Bitcoin, which is issued by a non-government entity, but an electronic currency that is issued by the government. And the central bank in Britain is so invested in exploring this idea that they're calling it Britcoin. And the idea is that now every private citizen, not just the banks, have accounts with the central bank, but everybody has an account with the central bank. But it's an account, so why don't they do that currently? Because if you try to do that currently, it reveals your identity. Like when a bank has reserves with the central bank, everybody knows that that bank has reserves, and it's kind of explicit what it is. And one advantage of cash is that it's anonymous. It sits in my wallet and is completely anonymous. So the advantage of central bank digital currency is that it can mimic all the characteristics that you value in cash. It's divisible, it's anonymous, it can be used for secure transactions and so on and so forth. So I'm just gonna be listing the properties there. It can coexist with conventional deposits, so it doesn't mean that you need to get rid of deposits, but you can withdraw from your bank account in the bank and put in your electronic wallet, just like you do with Bitcoins nowadays, except that now this is guaranteed by the central bank, not by a non-existent governmental entity like Bitcoin. But if that's then the case, so the central bank guarantees the convertibility and so on and so forth, then the central bank can charge as much of a negative rate as it wishes, because nobody has the opportunity to convert that into some other thing, because there is no other thing, there is no cash. So I understand perfectly well that this is a perversion of the entire idea of digital currencies, which was meant to take the government's hands away from the control of the currency. Now I'm trying to put the whole thing back into the fold of the government, but as I say here, so this is just the conclusions, that interest rates being negative is nothing special. They work in negative territory the same way that they work in positive territory. There is this inconvenience of the physical lower bound. It means that you cannot go very negative. However, if you are really serious about fighting depressions, and those are things that happen scarily often in the economy, you shouldn't dismiss any possibility as being silly. You should try to investigate what are the real consequences of it. And I would say that it's better to go big or go home. If you just want to do this kind of timid experimentation that the Swiss central bank was doing, that just confuses people. So if you are really going to go for negative interest rates, then just say what you're doing and be explicit, and then see what the change in behavior is going to be from firms and consumers. So I said that I didn't write this paper to make friends. I don't always write contrarian papers, but when I do, they are on negative interest rates. So thank you.